Good morning, everybody. My name is Chris Malmstrom. I'm the Vice President of Sales over at Alpine Brokerage, and I want to thank all of you for joining us today. We've got an exciting meeting for you this morning. We have a gentleman by the name of Matthew Fitch, who is an advanced markets attorney over at Prudential. He's going to be talking to us about the Tax Cut and Jobs Act. Everybody we've been hearing from is trying to figure out what does this mean to my clients and what are the opportunities and obstacles associated with that. So we wanted to bring on an expert in that exact topic and have him go through. Obviously, he's not going to go through every single aspect, but he's going to focus on some of the things that are affecting our clients and some of the opportunities that he sees in those various markets. So without any further ado, I am going to hand this over to Matt Fitch. And Matt, please take it away.
Thank you. Good morning, everyone. My name is Matt Fitch with Prudential's Individual Life Advanced Markets Group. And I'm excited to be here to talk to you today about the Tax Cuts and Jobs Act of 2017, and in particular, how we feel it impacts the life insurance business for better and in some cases, possibly worse. Let me just scroll through our disclosure. Very quickly. This material does not constitute tax or legal advice, etc. Okay. So the tax bill itself was massive. It affects every individual in the country, nearly every single business. It covers things as far-ranging as the tax rules around craft beer brewing, the expensing costs of replanting citrus groves, taxing nonprofit endowments in the case of certain private universities like Harvard, I guess is the big name there. So there was a lot there. It's a huge, huge revenue bill. And our job, of course, is to determine what in this massive bill is important to our wholesalers and our partners. For some statistics, what we have here is from the Urban and Brookings Tax Policy Center. And I won't go through these in detail, but the upshot that the author of this was trying to impart was that individuals generally only benefit on a temporary basis. So the purpose of this bill was really to streamline the business climate for the country. And the individual provisions, although they're significant, really only represent a fraction of the overall tax benefits that are going to accrue. Most of them will accrue to businesses and owners of those businesses, including their shareholders. So because most of the individual provisions are temporary, time is limited in terms of the opportunities that are there for you and your clients to take advantage. So here's what we'll cover. We're going to cover in the first two sections the basics. So what is the tax? What does the tax law say? We're going to talk about the changes that impact individuals and estates and changes that impact businesses. And then lastly, we'll try to cover some of the life insurance opportunities that we think exist going forward. So first, changes impacting individuals, and I have to tack on estates there because they're treated as individuals. You've probably all seen something similar to this chart, and what it does is it cross-references the tax rates for individuals under the former and the current rules. You can see on the married filing jointly side, there's a very small block of payers, like in the 400,000 to 425 range, who are going to pay at a higher maximum marginal rate than they were before. But for everyone else, the top rates and therefore their effective rates have fallen. Okay, this is temporary. Again, can't stress that enough. These rates are going to expire in 2026. And on the single side, you can see there are quite a few more taxpayers paying at a higher marginal rate, most significantly 157 to 195,000 and 200 to 425,000, which is a pretty big block. So you can see that the benefits here are skewed more toward married taxpayers than single and head of household, but it is what it is. Here's what hasn't changed. It's important to understand this. So capital gains and dividend treatments have not changed. The tax rates for long-term capital gains and qualified dividends are exactly what they were before. And the 3.8% net investment income tax to pay for the Affordable Care Act, otherwise known as Obamacare, is intact. So that wasn't changed. And I speculate it's because, as long as the Affordable Care Act is law, it needs to be paid for. So they more or less had to leave that one alone. There were changes to the standard deduction. It roughly doubled for all filing statuses, as you can see. The flip side to that is that the personal exemptions were repealed. So you would lose about $4,500 of exempt income per individual on the tax return in exchange for a higher standard deduction. There were also big changes to itemized deductions, and I'm sure this is old news to most of you, but I'll run through it very quickly. Mortgage interest. So before, you could deduct interest on a home loan of up to $1 million without limit, except for the P's limitation, which is another ball of wax. That's also repealed. So extremely high earners, they couldn't deduct unlimited amounts, but in general, if you had a mortgage up to $1 million, you could deduct all the mortgage interest that you paid in a year. And now the size of those mortgages is capped at $750,000. So if you take a new mortgage, you can only deduct the interest on it up to the portion attributable to $750,000 of debt. And home equity indebtedness is now completely non-deductible. So let me just be clear. If you had a mortgage already up to $1 million, you're grandfathered. Nothing changes for you. If you take the new mortgage out, you're capped at $750,000. If you had home equity indebtedness or you acquire it now, you can't deduct that for the next 8 years. There's some question around whether home equity indebtedness used to actually purchase a home or make improvements to it can be deducted, and I think we're going to see some guidance from the IRS on that, but we haven't yet. Charitable giving, this didn't really change. It's still fully deductible. If we're talking about, the only thing that's different is the percentage of AGI that you could deduct for cash contributions. So nothing's changed around the rules of, cash versus non-cash contributions and how much you can deduct of your AGI, depending on what type it is and what type of charity it is. Those are rather complex and they haven't changed. The only thing that's changed is that you can deduct now 60% of AGI for cash contributions to a public charity versus 50% before. And I think possibly the reason here is that because a lot of people are losing itemized deductions for the reasons we'll talk about in the next slide, there's a fear that charitable giving may drop off a little bit. So the 60% AGI limit for deductibility was inserted to maybe protect against that happening, or perhaps to give the maybe it was done for political reasons. But in any event, it's really only very wealthy donors who are ever going to benefit from that anyway. And by the way, I was at the Heckerling Institute for Estate Planning in Orlando, Florida in January, and they made clear, we had some very interesting panelists, very experienced panelists in the field of charitable giving, and they made clear that people do not give to charity for tax reasons. And so if there's any fear that charitable contributions will drop off, I think that's probably going to prove to be unfounded. But anyway, we had that anyway, 60% AGI deduction for cash gifts to public charities. Here's some more about itemized deductions. We talked about the mortgage interest. Now there is a cap on state and local income and sales taxes and real property taxes. So if you itemize deductions before on Schedule A, you could take, again, I'll say, in a qualified sense, an unlimited deduction for your state and local taxes. And now you're capped at $10,000. That's per return. So An individual has a $10,000 cap, and so does a married couple. So that's it. It's 10,000. And the impact of this is going to fall mostly on what are known as high tax states, such as East Coast states, Northeast states, California, where there are a lot of public services, and they're funded through state and local income taxes and real property taxes. Medical expense deduction, this was made a bit more favorable than it was. It used to be that you could only deduct unreimbursed medical expenses to the extent they exceeded 10% of your adjusted gross income. And now that floor has been lowered to 7.5%, only temporarily though. I'm not sure what the purpose of this was, but all it means is that someone who has very significant unreimbursed expenses can now start deducting those at a sooner entry point in the income scale. Miscellaneous itemized deductions. These were things such as deducting investment expenses, management expenses, and tax return preparation fees, things like that. Those are repealed. Again, this is all only temporary. It'll all come back in 2026, but for now, those things cannot be deducted. And that's significant for trust and estates who employ investment managers and end up deducting those fees at the end of the year. They won't be able to now. This is a big one here. The estate, generation, skipping transfer, and gift taxes have the taxes are the same. It's still 40%, but the exemption equivalent has doubled from a $5 million base to a $10 million base, which translates for inflation from it was going to be 5.6 million in 2018. That was announced in October, and now it's actually 11.2. That's going to be adjusted downwards a little bit in the next few months. So really 11.18 is what commentators are saying. But that's pretty significant, obviously. If you have wealthy clients who are interested in gifting, making large lifetime transfers, or who die within the next 8 years, the tax landscape has changed for them quite a bit. The annual exclusion amount was announced at $15,000 in November, and that didn't change. That's still $15,000. And we still have a step up in basis on capital assets at death. So those are the highlights for individuals, and now we'll talk about the highlights for businesses. The big one here is the top corporate tax rate. So the corporations were taxed on a bracket scale before from 15 to 35%. To the extent corporations were paying taxes, they were paying anywhere between 25 and 35%. It was very difficult to pay less than that because the brackets themselves are so narrow at that range. So now what we have is not a bracket system, but a flat tax of 21%. And let me preface this entire section by saying, unlike the individual provisions, I did say this up front, the business provisions, most of them anyway, are permanent. So this 21% is a big, big deal for corporate America and shareholders who participate, in the profits of big companies. The second big thing for businesses, and I have to stress here that this is really an individual provision, but we talk about it in the business provision because it impacts owners of businesses. So if you're an owner of a pass-through business, meaning an S corporation, so you're a shareholder in an S corporation, you're a partner in a partnership, even if you're a limited partner, if you're a member of an LLC, or if you're a sole proprietor, it's possible now to take a 20% tax deduction on your business income. So you're doing this on your personal tax return because that's where pass-through owners actually recognize the tax on their business income. But since it is your business, we're talking about it as if it was a business change. Because it's an individual change, I keep going back and forth, and I'm sorry, but but this is going to expire. So what we have here is the top rate, corporate tax rate of 21%, permanent. The 20% tax deduction for pass-through owners, temporary. One more thing that's permanent on the corporate side is that the alternative minimum tax for corporations is gone forever. That's been repealed. So those are the two big ones for corporations, 21% flat tax, corporate AMT repealed, and then we have this temporary opportunity with pass-through owners who can potentially take up to 20% off of their business income and not pay any tax on it. Before I leave this slide, I just want to run through a couple of examples because I think it's important. This is something that a lot of people have questions about regarding the 20% tax deduction available to pass-through owners. So first of all, the 20% is personal income derived from a trade or business activity. So it's not 20% off your entire income. If you have separate investment income, that gets taxed just as it ordinarily would. It's really only, again, income derived from a trade or business, and there are limits, as there always are. The first limit is that there are certain business types that only qualify below a certain threshold limit. So put another way, up to $315,000 of business income, and here I'm talking about limits for a married couple filing jointly. Up to $315,000 of business income, the 20% deduction is available to everyone, anyone who qualifies as a pass-through owner. So that's pretty significant. But then it begins to phase out depending on what type of business you have. So there's an entire class of businesses that phase out and then are excluded above $415,000. So there's a $100,000 phase out where the 20% applies less and less until it doesn't apply at all. And these types of businesses are commonly referred to as service businesses, where the primary value of the business is in the reputation or skill of the owner. And it's even more specific than that. In the actual statute, it lists them all out. So practice of law, the practice of medicine, actuarial science, professional athletics, performing arts, brokerage services, and there are several others that kind of escape me my memory at the moment. But those folks are not eligible to take the 20% deduction over and above these phase-out limits of $415,000 for a married couple filing jointly. The reason is that this 20% benefit was really slated toward the political term as job creators. So you have to be someone who actually employs people and pays a W-2 wage to individuals who work for you to get this 20% deduction. That's one side of the coin. There's a flip side of it too, which was added last minute, which is for, it's going to benefit mostly property managers and then property developers, right? So I'll run through these two examples here very quickly. So for W-2 wage payers, right, there's this test that you have to meet to get your full 20%. Let's just use that as an example. A person who owns a business, an S corporation, whatever it is, they employ, 10 people. They have trade or business income of $1 million for the year, and they've paid total wages to their employees of $500,000. So the way the formula works is 50% of W-2 wage income, in this case $500,000, is $250,000. And so what this means is you get the full 20% because 20% of $1 million is $200,000. So by paying $500,000 in wage income, you get take a 20% haircut off of your $1 million of business income and only pay tax on $800,000 of it. And not only that, but everyone's individual tax rates are down from where they were for the most part. So on top of that, you're going to do pretty well. The other side of the coin, the active property managers, they don't have to have any W-2 wage employees at all. The test there is the greater of 2.5% of unadjusted basis of qualified property plus 25% of their wage income that they pay. So you could have zero wages paid out. If you had $10 million in unadjusted basis in your property holdings, that gets you to $250,000, 2.5%. And if you have $1 million of income, this is just like the previous example, your 20% deduction would be $200,000, 20% of $1 million. Here, $10 million of unadjusted basis at 2.5% gets you $250,000. So you exceed that 20%, and you can therefore take the full 20%. So this is very interesting for one very important reason, is that it's the unadjusted basis of qualified property. So what's significant about that is that most property owners, well, all of them really, are going to depreciate their property, right? So you buy a building, you start depreciating it. That's what everybody does. But this doesn't require you to use this depreciated value in figuring this 2.5%. You can use this unadjusted basis, which is what you paid for it. Even if you bought it 20 years ago and you depreciated it down to nothing or next to nothing, you can still take 2.5% of that original purchase price in figuring your deduction. So it's a pretty good deal. I hope I explained that well. It is complicated, but important to know if you think that you may have clients who would fit that description, which leads us into discussing life insurance opportunities. So this slide, talks about non-estate tax reasons, non-tax reasons for buying life insurance. Lower tax rates can mean clients will have more money to allocate to life insurance. And it goes without saying that if you have more money in your pocket, this may be a good time to buy life insurance, because if you're going to accumulate it, the cash values for income, possible income in the future, it's good to get in now at a lower rate, because rates will go up again. As we know, as I keep repeating, the tax cuts for individuals will expire in 2026. And life insurance is a better value for, it's always a good value, but it's a better value now because it's cheaper. Tax-free acceleration and policy death benefit from chronic and terminal illness costs. That's always a good deal. It's always has been, but now it's cheaper to get in and have that as part of your portfolio. And the idea about having a death benefit to replace income for survivors, providing money for debts and estate settlement costs, and other estate costs, and that hasn't changed any at all. Again, because life insurance is technically less expensive, because you always have to pay for it as an individual with after-tax dollars, it may be a good time to get in. So here's an example. It's not on the slide, but I'm going to read it to you. Say you have a client who's interested in a LIRP, and let's just say they're a pass-through owner. And pass-through owners are, they can't really use their business money to pay premiums, because it doesn't benefit them at all. They have to pay tax on all the income. Life insurance is a non-deductible expense generally to a business, and so they would have to pay out of pocket for it, just like anybody else after tax. Using as an example, $100,000 premium. If your before tax earnings were, your effective tax rate was 33% before the Tax Cuts and Jobs Act. That $100,000 would cost you about $150,000. If you're a pass-through owner and you get the 20% haircut on your business income, which drops your effective tax rate down to 26.4, for example, that same $100,000 of after-tax premium costs $136,000 instead of $150,000. So it's not an enormous difference, but it's pretty significant. If someone liked LIRP before, when I say LIRP, life insurance and retirement planning, but balked at earning $150,000 to pay a $100,000 premium. Now, again, it's a little cheaper. You have to earn less to pay the same premium. The same idea could be used with a spousal lifetime access trust. So this, or SLAT, this has always been a way for clients to keep assets outside of their taxable estate while allowing one partner in a marriage, the non-grantor, to access trust income and principal if they need to. And with trust-owned cash value life insurance, distributions from the trust are still tax advantaged in the trust just the same way as they are when they're individually owned. Policy loans or withdrawals are taken out tax-free generally. So you've got that advantage, but also these assets are outside of your estate and they're away from your creditors if you're using the spousal lifetime access trust. So a typical client here would be an affluent professional who is maybe not able to take advantage of this 20% pass-through deduction, but they still have, they're still realizing a drop in their effective tax rate, and they're concerned about future tax on the growth of their estate and the potential for creditors. So here, talking about professionals who are worried about lawsuits. The SLAT addresses these concerns, and now, just as in the previous example, I used with a $100,000 premium costing, instead of $150,000, $136,000, it may make more sense for a person to look at funding one of these. Chronic care planning, I did cover this a little bit. This is basically the idea that it's always a good value to look at accelerated death benefits for the purpose of funding the costs of a chronic illness. And now it may make even more sense. Life insurance is very flexible. It can serve many purposes, including this one. And again, if it's less expensive now, from a before and after tax analysis standpoint, to buy it, this may be the time to get into it if you have the cash flow. So gifting opportunities, this is another big one. A higher basic exclusion amount means more money can be gifted tax efficiently. So if there are clients who already have existing gifting plans or think about starting new ones, now they can move much more out of their taxable estates to future taxable estate tax-free today because of the doubling of the exemption equivalent amount to $11.18 million per individual. So that's obviously $22.4 million per married couple. So this might sound familiar to a lot of us because, again, this is temporary. And in 2012, when the Tax Relief Unemployment Insurance Reauthorization and Job Creation Act of 2010, TRA, was about to expire, there was a lot of talk and even panic about planning then because the $5 million exemption that was in place then was set to drop back down to $1 million for gifting and estate tax purposes. And so there were a lot of people who actually did pull the trigger and make large gifts, and a lot of who didn't. And obviously sunset didn't happen, but here we're faced with a very similar situation where we have a potential sunset. We do have an actual sunset in the law in 2026 of the exemption amount, and it's time to have those conversations again. There may be clients who retort with this, the example I just gave in 2010, well, you asked me to, make large gifts in 2010 because I was going to lose my opportunity to do so, and then it never happened. Well, you can sit on the fence, so to speak, and still plan. One way to do that is for clients who, get underwritten today, get life insurance today, and enter into a split dollar arrangement with their trust. So they're not actually making gifts of those premiums. They're not gifting millions of dollars for premiums or however much they're able to now with the doubling of the exemption. They're treated more as loans, and so they don't have to actually take advantage. But they get underwritten and they get the planning in place, then if it looks as if we are going to have a sunset, as we get closer to 2026, and the opportunity to double your gifting goes away, at that point they can rip up the split dollar arrangement, effectively make a gift at that point and use it before they lose it. Business planning, there's going to be a lot of talk around business clients revisiting their choice of business entity. I'm not sure that really makes a lot of sense. What this is referring to is clients switching from pass-through ownership to C corporations, changing from an S corp, dropping your S corp election and becoming a C corporation again, or reorganizing as a C corporation from an LLC or something like that, because of this new permanent 21% corporate tax rate. The thing to remember there is that C corporations are still taxed twice. So even though the tax rate to the corporation itself is now 21%, there's still a tax on distributions to shareholders, aka the dividend tax. And there's also another tax that's payable on earnings, which is the retained earnings tax. So I'll talk a little bit more about why it could make more sense in light of the retained earnings tax to look at life insurance for business owners. And here again, I'm talking about C corporation, corporate owners. The reason is that a lot of shareholders in closely held businesses, closely held corporations, do not want to take distributions. And just to reiterate, you're taxed twice. You're taxed at the corporate level, and then when you take distribution from your corporation, you're taxed at up to 20% at that point, plus the Obamacare surtax in some cases of 3.8%. So 23.8. So you've got a 21% corporate tax plus a potential 23.8% individual tax on distributions. You're over 40%, right? So is that really, does it really make a lot of sense to switch to a C corporation? I don't think a lot of people will make that election. But for those who are already C corporations and don't want to change, it may make more sense now that you have more cash in the business to look at life insurance as a planning opportunity for the business. Now, life insurance is not deductible for a C corporation, but if you have more money around and you've gotten rid of this pesky AMT, which would have taxed your life insurance death benefit, life insurance can be more attractive now. So you have more retained earnings. You don't want to keep them because if you pile up cash in your business, you're subject to, again, this thing I mentioned called the retained earnings tax, which is a 15% tax on undistributed income, right? So if it's not taxed as a dividend to shareholders, it's taxed anyway as a retained earning after a certain period of time. So companies who don't want to pay it out to shareholders, the shareholders don't want it, can look at things to do with it. Again, they've taken all the deductions that they need to. We're talking about net earnings here. Using net earnings for certain life insurance applications is a qualified way to get them out of the net retained earnings bucket. So one way would be an entity purchase arrangement, right? So a buy-sell. So you have the two types of buy-sell where you have a cross-purchase. The shareholders themselves own the life insurance, or the entity purchase where the business itself owns the life insurance. So it's going to cost money up to over 40% to get the money in the hands of the shareholders to buy the insurance. Why not look at it as an entity arrangement? Have the business own the policies. They're only paying 21% on the money, and by doing it, they get the premium dollars that they spend out of this retained earnings bucket and won't be in danger of being taxed getting 15%. So that's just one example, an entity purchase agreement, life insurance. Non-qualified executive benefits like split dollar, deferred comp, executive retirement plans. These are also legitimate uses of funds, while non-deductible, that remove net earnings from the retained earnings tax. So again, corporations that have extra money around at the end of the year, which a lot of them will because of the new lower rate, these are potential places to park that money and use it to the business's advantage. Key person coverage is another one, right? So all of these were problematic from a certain standpoint before. I mean, it makes sense to have corporate-owned life insurance with these strategies. We talk about them all the time. Now it's cheaper to do them, but also the repeal of the corporate AMT means that the corporate-owned death benefit is no longer a threat to corporate net income, which it was before. So when you buy life insurance, obviously you don't expect the person to die, or we wouldn't underwrite it. So, the accountants can spend all year very carefully planning the corporation's margins, and then if someone dies and there's a corporate-owned policy on their life, that death benefit can be counted in computing the AMT and can then push the corporation into the AMT, basically, destroying all the well-laid plans. That was always an objection from an accountant's standpoint to corporate-owned life insurance. It was always a caveat, right? So life insurance made sense, but there was this caveat. That caveat is gone now forever with the corporate AMT being repealed. So those are the things I wanted to talk about. The actual basics of the tax changes for individuals and corporations, and then some of the life insurance opportunities. Before I close, I want to talk about clawback, because this is another question that you're going to be getting, I'm sure, if you haven't already. So clawback, this was another topic of conversation, heated conversation in 2012. And it refers to a situation where you have, you're accounting for lifetime gifts for estate tax purposes conflicts with prior law. So if you make a gift at a time when the gift in estate tax exemption is $10 million per individual, let's use a round number, and then when you die, the exemption is actually $5 million. The estate tax rules, the way they're written, require you to use the exemption that's in effect for figuring lifetime gifts and their inclusion in an estate. They require you to use the exemption amount that's in effect at death. So you can't go back and say, wait, I had $10 million available. It shouldn't count. Technically, the estate tax rules would have you only allow or allot a $5 million exemption to those gifts. The additional $5 million would have to be included in the taxable estate and taxed there. That's the idea of clawback. We kind of dodged that bullet in 2012 because the law didn't sunset. Well, it did sunset, but then there was another law to replace it. So there was no clawback. There wasn't any possibility for it. But now we're in the same situation where we have a temporary exemption increase that's slated to drop after 2025. So you could make very large gifts today, and then when you die 30 years from now, your executor could be working out your tax return and saying, well, we have to use today's exemption, which could be, could be $1 million then, very unlikely, but it could be, and pull the value of those gifts back into the estate and tax them at 40% or whatever the rate is at that time. So this is going to be very concerning to people, and especially as we get closer to 2026, unless the law is made permanent before then. In this legislation, unlike in the 2010 Tax Act, there was no provision to deal with it. This legislation expressly authorizes the Treasury to regulate this issue, but it doesn't say how to do it. It just says that they may. And so, again, that leads to more uncertainty until and unless the Treasury releases the regulations around this, which they may or may not. There's still going to be those questions. And so it's always going to be unlikely that there will be a clawback, even if we go back to the current, the 2017 rules around estate taxation. But it's a possibility. So it's a conversation that you're going to have to be prepared to have at certain points. And of course, that's why we're here in Advanced Markets to help you with those conversations, because it is a very complex rule. So again, that's pretty much it. We talked about how the Tax Cuts and Jobs Act impacts individuals and businesses, some of the life insurance planning opportunities, and I think most importantly now is that clients need to know that something is going on and that it affects them. Whether that involves additional planning or not, they are affected. Everyone is affected. So the conversations are there to be had, and they may lead to review and further planning. So again, we want to be a resource for you to help you have those conversations and make them productive for you and your clients, and take advantage of the opportunities that are here. I wish we had a Q&A period because we're ending a little early, but that's really all I have to say. Thank you very much.
And Matt, thank you, first of all, very much for coming on and going through this. I think there's a lot of information in there, a lot of very good information. It's probably the third or fourth time I've heard quite a bit of it, and every time I hear it, I pick up more. So to that effect, there's a couple things that we're doing here to help you guys out. First of all, we recorded this, and it will be added to our website within the next 24 to 48 hours. So if you do not currently have a login to our website, contact your account executive here, and we'll be happy to get you one. We also have a handout that goes through a lot of this information. It was what he actually built this off of. Prudential put together a real nice handout. Our account executives would be happy to get that out to you as well to review and go through this. I'll tell you, a couple of things that I keep hearing every time I listen to this presentation, a couple of the opportunities that continue to stand out to me are the fact that, a lot of our wealthier clients and our business owners are going to have more money in their pocket, and they're going to be looking for opportunities and ways to take advantage of that. And talking to them about the power of tax deferral now and tax-free access later. One of the things that I don't think I can count the number of times Matt said in the presentation, a lot of these rules, a lot of these changes sunset, and in 2026 they come back. So you have a limited time, and more importantly, your clients have a limited time to take this extra income and put it somewhere where it can continue to grow on a tax-deferred basis, and when they need it for either growth in their business or for personal needs, they can access it on a tax-free basis. I would challenge any of you to find another opportunity out there that they're going to be able to do that, no matter what the tax brackets go to. So that to me is a huge one. The other one that he was talking about was getting money out of the estate, and he talked about possibly having it clawed back. That's always a risk, but I'd rather take the risk of, hey, let's get the money out now. And because if we don't and they choose not to claw it back, we've lost the opportunity. So let's get that money out. And I loved his option of using the SLAT so that you can get the money out of the estate, still have everything tax deferred, have tax-free access. There's some outstanding planning opportunities available, and we're happy to spend some time with you on your cases, on the clients you're working with, and help you take advantage of some of these opportunities, because if you don't talk to your clients about it, somebody else will. So once again, I'd like to thank Matt and thank Prudential for having him come on and go through all this. Please give us a call with any questions you have. With that, we are going to close off today's meeting. Thank you very much, everybody.